Hey everyone, me Kevin here. In this video, we're going to talk about Cathie Wood's latest warning for markets. And at the same time, I am going to incorporate something that's really, really important. No, not just a newspaper, but the Financial Times. Hidden all the way on page 17, way at the bottom, is something really important that we're going to talk about that relates to this in just a moment. But first, we're going to mention that you should get life insurance in as little as 5 minutes via the link down below. Go to metkevin.com/life or use that link down below to Apple Pay or Android Pay for life insurance you can get in as little as 5 minutes. For now, though, we will listen to what Cathie Wood's greatest fear is going forward. All right, let's listen in, folks. See what we got.
We've been saying for some time that the risk to the economy is more on the side of deflation than inflation. So as COVID created all the destruction that it did. And
well, quick note worth noting that she's starting off right away by saying, hey, risk here, deflation, not inflation. That is the opposite of what consumers feel right now. Consumer expectations are that inflation is going to be at all-time highs for years and years and years going forward. But is it possible that consumers are actually lagging in their expectations of what's going to happen? That is, consumers should have felt this way a year ago for high inflation now. Now we're in high inflation. Now consumers suddenly think inflation's going to stay around forever. And are they going to be wrong? Are we actually going to deflate? Let's see why Cathie Wood is into deflation. And then we got to talk about something in that article that's going to be very important.
Supply chains really being thrown off. We've been through a period here of inflation, which I think investors are baking into the cake. That's the underlying assumption out there, that we're in an inflationary period and that it was turbocharged by the supply chain disruptions that occurred during the coronavirus. And of course, they will be focused on monetary policy when they say that.
She's essentially saying, hey, look, if investors are worried that inflation is getting worse because of supply chain issues, they're going to look at every single word that the Federal Reserve says, because when the Federal Reserve talks, it kind of gives us a little bit of a heads up in terms of, oh, what's the Fed going to do about inflation? Do they actually think it's here to stay, or are they suggesting it's here longer, or what? And that is actually exactly what Jerome Powell is saying. He's saying inflation has lasted longer and been more present than it was initially expected. However, they still expect inflation to inflect downwards. Now, will inflation inflect all the way downwards to a deflationary level? Let's see.
Student of economic history, and I've lived quite a bit of it myself, so seen a lot of markets, and started in the business during the 70s. I was in college when inflation was raging. So I know what that is. And I truly believe we are not going back there, and that anyone planning for it is probably going to be making some mistakes. So the three sources of deflation that we see, to go into a little more detail, on the innovation side.
Pay attention, by the way, to this part, because it's going to relate to something very, very important here. A lot of people have been talking about this right here being a big cause for inflation coming, but the counter argument here is insane. So we're setting this up with Cathie to Trojan horse the end of this. And I'm being transparent about my horse.
Logically enabled innovation. We are in a period today like we have never been, never. I mean, you have to go back to telephone, electricity, and automobile to see three major technologically enabled sources of innovation evolving at the same time. Today, we have five platforms: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. All
five of those things, by the way, have nothing to do with the first three things. Like, we didn't have DNA sequencing back in the day. It didn't have artificial intelligence back in the day, or robotics back in the day. Or it's incredible, the place we're in right now. And she's right. I mean, think about it. Look, when the iPhone first came out, I was using the T-Mobile Razr, and that was cool. Why was it cool? Because it had a color screen, and it was more pleasant to send texts in. It still had a physical keyboard. The iPhone came out, and people were like, oh my gosh, there's no keyboard. Whatever will we do? Humans must feel a response from a key in order to be able to type. Boy, what a inappropriate argument that was from Consumer Reports. Consumer Reports did a whole piece about how getting rid of the keyboard was the stupidest thing you could ever do. That aged well. But anyway, let's keep going here. Because obviously, and ask yourself, how much more productive, really, like when you think about this for a moment, let's say the T-Mobile Razr is $400 and the iPhone's $1,600, right? So the cost is 4x. It's 4 times as expensive, let's say, back in the day. But then again, I am comparing and so I really have to ask you to say, how much more productive could you be on an iPhone today compared to a T-Mobile Razr back in 2007? Probably 10 to 20 to 50x with apps, navigation, background app notifications for news, emails, text messages, FaceTime, Zoom on your phone, hotspotting to your laptop so you can take your laptop and actually function out in society. Don't get me wrong, I was able to hotspot back in 2008 because I remember taking my big old 17-inch Toshiba laptop to go play World of Warcraft on it on the travel by tethering it, but I couldn't actually do anything other than kind of standing there and trying to hit rock nodes because there's no way you're fighting tethering back in 2007. But I think the point here is very clear. Yes, technology makes things much more efficient. Let's keep going.
Which are deflationary, and not just by a little bit either.
And that's why I made this argument, is that generally technology makes things cheaper. Like a flat screen TV, for example, that used to cost $2,000. I know that because I sold my World of Warcraft account, made the dumbest financial decision ever, and took that $2,000 and bought a 48-inch flat screen TV for $2,000, a Sony Bravia HD TV. My dad ended up taking it from me because he really liked it. We agreed to that. I wasn't using it as much. I should have invested that. But nobody taught me that. Anyway, I had to learn that all myself. But the point is, that TV today is something you could pick up for like $300, right? That's deflation in technology. Another form of deflation, even when phones are getting more expensive, is the fact that your productivity is skyrocketing. That, folks, is a very important key that I'm dropping you for what we're about to talk about.
Jeff Gundlach and Howard Marks, and I think Stan Druckenmiller and Ray Dalio, all of them, I think, have been very, very concerned about a deflationary bust. And we agree with them in this respect. We think it's going to be balanced by a deflationary boom. So that's where we differ. But where we agree is that
this is actually a very big fork here, okay? Ray Dalio thinks that as prices fall, potentially the economy slows, people are going to get into the great deleveraging, pay off debt, pay off debt, pay off debt, pay off debt. The economy shrinks even more and more and more and potentially collapses in a deflationary spiral. Cathie Wood thinks, no, as prices come down, we're going to become so much more efficient and so much more productive, and our economy is actually going to grow much faster than we think it's going to grow. Different trains of thought. I am on the side of Cathie here, but I still listen to Ray Dalio and the others like the Burries of the world and so on.
There are companies who thought the world would never change and have been, again, catering to short-term shareholders who wanted that extra penny or two in earnings, and so got it by having the companies leverage up and take more debt and shrink the number of shares. And they've also been focused on dividends. They are probably saddled with products and services that will become obsolete because of the record-breaking amount of innovation taking place today. And in order to service their debt, they are going to have to cut prices. And
this, by the way, is just a reference to companies that are more indebted, like, let's say, Ford Motors has a lot of debt. Personally, I don't think like they're overly indebted. Like, I don't think Ford's going anywhere anytime soon. Obviously, I prefer the Teslas and the Neos of the world. But, and I do disagree and depart from Cathie Wood here, where she suggests that Tesla and the automotive space is going to be a winner-take-all or winner-take-most space. She doesn't say all, she says most. I think there's going to be a healthy amount of competition in EVs. I do think Tesla's going to take the Toyota lion's share, but that only needs to be like 15% of the market. I think there'll be plenty of room for like a Neo to hang out with 5% or something like that, maybe even more. We'll see. I would honestly love to drive a Neo. If anybody has a connection with where I could try out a Neo, I will fly to China. Hit me up, okay? staff@meetkevin.com. All right, let's keep going.
Those goods and services that are on their way out anyway. So I am concerned about that. And
and in case I didn't finish that thought, basically, if Ford has a lot of debt, the argument is that they might have to drop their prices to service their debt to stay competitive, and that's deflationary. So you've got innovation deflation, you've got dropping your prices because you're no longer competitive deflation, and then, of course, we continue on.
And according to our estimates, in the year 2035, because of automation and artificial intelligence, we believe that GDP here in the United States will not be 28 trillion, which would be if you drew the growth, linear growth, that's where it would be. But instead will be $40 trillion. And it is our...
Okay, that is a big claim. She's suggesting then rather than our GDP growing from $21 trillion to, let's say, 28, kind of that linear growth, which linear growth just means line, right? Just moving up. Just to give you a quick little example here, we'll jump right over here. So linear growth, this is what Cathie is saying. These are sort of the estimates now that by 2035 will be somewhere like this. She's suggesting that this is wrong, that because of increases in productivity, we're actually going to see something more in line with this, $40 trillion as a GDP by 2035. And the difference here, this extra fat here, so to speak, that is productivity due to none other than innovation. Boom. And that's what Cathie would invest in, after all. I like investing in that too. Let's keep going.
Focused only on innovation to figure out where that extra $12 trillion is going to come from. And then to educate and orient our investors, of course, but also parents and grandparents. You know, how should you educate your children? You know, how should you steer them so that they are on the right side of change? Because there are going to be so many exciting opportunities.
Wow, that is an incredible piece here. But what's more interesting, maybe not necessarily more interesting, but equally interesting, is this right here. Cathie Wood briefly touches on it, but folks, this is so understated. Every time I hear people talk about inflation, they're like, well, people are paying more money for people who work minimum wage jobs. It's like, yeah, we get it. Because less people who are, and this is statistical, less people working minimum wage jobs are vaccinated, therefore they're more likely to want to stay home or away from COVID potential exposure. At least that's what some studies have shown. It's not going to be true for everyone. It's just an increased percentage of people who work service jobs are less likely to be vaccinated and therefore less likely to want to return to work, which is one of the reasons there were so many arguments around, oh, well, maybe people go back to work after the unemployment boost expires. Whatever. The point is, we still have an elevated unemployment rate. And so people are wondering, okay, does this mean wages are going to continue to go up? And if wages continue to go up, does that mean we're going to continue to see inflation? Because if wages go up, this is like the child argument here. Like, this is very, very basic level economics, okay? Basic level economics. Well, if I pay somebody $8 an hour to make this cup, and now I have to pay them $10 an hour to make this cup, I'll have to raise the price of the cup by probably somewhere around $3 or $2.50 to make up for those higher wages and the extra additional costs that go with higher wages, like workers' comp and insurances, blah, 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 blah. So wages go up, prices must go up. That's the very elementary argument, right? That's like Econ like 100. We're not even at 101 yet, right? That's basic. Okay, you wanna graduate to like the higher advanced levels of economics? That's what you're here for. Okay, good. So this was a great piece. Ready for this? Okay. The great inflation debate, is it sustained or transitory? And one of the most important features of the consumer price index, or the measure of inflation and inflation in general, is labor costs. And labor costs are not just the wages that you pay. This is really important, and I think this gets missed so much, especially here on YouTube, is when people think wages up, they immediately think that's it, inflation must be going up, right? But there's this forgotten aspect of, wait a minute, there are two parts to wages. Wages are the actual hourly rate that you pay, so this is sort of the hourly rate. You could even call this sort of labor costs, and then you can call this hourly wages, just to make this a little bit more clear. But the other factor that goes into this is very important. and it's productivity. What if the person that I pay $10 an hour to make this cup can actually make me 2 cups and make, even though I'm paying them, 15% more, what if they can double their output and we can do 100x on our cup production, right? So productivity, very important. Now, Cathie touched on this, but didn't go deep on this. This was interesting. This author says, if productivity accelerates, unit labor cost should remain stable, and so should prices. So as long as wages go up with increasing worker productivity, we shouldn't actually see labor costs, the top costs before the fork, go up. And what's really cool is you could just type into Google St. Louis Fred, labor productivity, and you'll get this first Google result here. Labor productivity output per hour, all employed individuals. Let's go to just the last 5 years here. Look at this inflection point after the pandemic. So starting in, I guess you could really say, it's Q2. All of this right here is really Q2. In Q2, this inflection to the upside. If we drew this trend line continued, we did some technical analysis here, we'd be shy of where we are now. Maybe we'd be somewhere right here at this gray, or a marker or a reading of about 110. And we're actually at 1125. And we expect that pace of change, that rate of change, to accelerate in favor of more productivity as people start going back to work and continue to go back to work, since people have already started going back to work. If productivity accelerates, the prices should remain stable. Here is another thing. There are many reasons to believe firms will continue to invest and increase productivity. 1, they're sitting on mounds of cash as a result of stimulus programs and cheap credit. Earnings growth has soared, and labor is no longer such a cheap substitute for capital expenditure, and firms have to catch up after weak investment. In other words, because labor is getting more expensive, companies are now purposefully plowing more money into new machinery and innovation to reduce input costs because labor is more expensive. So in a weird way, as labor gets more expensive, the labor that we do hire becomes more productive because now it works with newly created or installed machinery, because that's the only way those jobs could be created in the first place, by being more efficient. And I've previously talked about how this pandemic has been sort of this, in my opinion, cleanse for corporations, where corporations were able to lay off tens of thousands of people and then just hire back the people that they probably found were the most productive. Now, that's harsh to the people who were not laid off, who were not hired back, but I'm talking in the mindset of an investor here, not to offend. So the shift from working at home during the pandemic may have also yielded efficiency gains. 65% of respondents felt remote working has been good for productivity. Jury is still out on this, though. Higher productivity growth, though, also means that the economy can maintain stable prices even in the face of higher wages. This was money right here. When you now look at this and you look at your inputs for inflation. Oh, car prices went up, airline prices went up, wages are going up. Yeah, but wait a minute, airline and car prices are temporary, wedding dresses are temporary price increases. Sure, the prices might stay at elevated levels for a while, but if people are getting paid more and they're being more productive, we can actually grow and inflect down inflation. Fascinating insights, Cathie. Fascinating insights, Financial Times. Thank you so much for watching this video. Make sure to get your life insurance in as little as 5 minutes, and folks, we'll see you in the next one. Thanks again. Bye.